See, in earlier chapter we learned that what is financial management, right? So we require debt and equity to be raised so that we can do the business in a proper manner. Now here in this chapter we are going to learn about financial markets, that is from where the money is being raised by the business. So we'll understand the entire concept of financial markets, the different instruments we have for short term and long term capital which we require. So let's start with first the concept of financial markets. See, in India or if you go anywhere, there are two major sectors. One is the household and one is the producer. Who is the household? Household is people like you and me, okay, who are earning. Let's assume you're earning right now. So, or let's take your parents, they are earning, so they have some money with them, okay, and they want to save that money for future, the whatever, after deducting the expenses from the salary which they get, they have some extra money which needs to be invested, okay. So these are the households who have the money to be invested somewhere. Now producers would be people who require the money, okay. So these are all business houses, businessmen who require money for their businesses, okay. So a financial market will come into place because it will help to link these savers and the investors by mobilizing the funds between them. Now remember, the producers or the business people I am talking about, they are also known as investors, okay, because they are investing the money, and we are the savers because we are saving the money which we have earned and we want to earn a return on that later as the life progress, okay. So basically it performs a allocative function. What is that? It allocates or direct funds which are available for investment into their most productive investment opportunity. See what happens here, because there is a place where the saver can come and invest money and the investor can come and take the money from that particular market. So what happens, because there is a forces of demand and supply in place in these financial markets, so when the saver would invest, when the saver would come and save the money and invest in these financial markets, that is, it would give the money to the businesses, that would be purely based on the performance of these investors or business houses, okay. So that is the reason it is being said that the investment would be made in the most productive investment opportunity. So the company which is the most efficient will attract the highest amount of investment, okay. Now when the allocative function is being performed in a decent manner, or let's say is performed well, then what will happen, there would be two consequences of it. The first, the rate of return which is being offered to households would be higher, okay, because I am giving it to a competitive firm. So that means, as per the financial management, what we learned, that when the company is raising capital, okay, or it is taking debt, if it has a proper vision and it has done the calculations on a pretty good basis, then it will always have a rate of return which would be higher than the cost of capital raise. So in that scenario, the households will get more return on the investment they have made, okay. The other thing is, scarce resources are allocated to those firms which have the highest productivity of the economy. See, as I just told you, because allocative function is being followed and the demand for forces, the forces of demand and supply both are there in the market, so that is the reason the good companies attract more in people, that is the savers or people who want to invest money, and that is the reason the money goes to a business which has highest productivity for the economy, okay. To, if I have to see this in diagrammatic format, so here we have the household, we have the savers. When I speak about household, so that I'm talking about the house, total families, the savings they have, okay. When I'm talking about savers, so nothing but individuals who are saving money, so they would either deposit the money into banks. So if banks get the money, what happen, when they have extra money, they would give it to businesses on a rate of interest. So when a rate of interest is being charged, so what happens, banks are earning, okay. So again the money of household and savers is being allocated in a productive manner for the development of the economy. Okay, similarly, when it comes to financial markets, people, that is the business houses, business firms and investors can raise the money from households and savers who want to invest in the financial market instruments.